All right, well, let's take a look at what's been happening with the latest market action with our expert insight here. Jim Smigiel, SCI's Chief Investment Officer, joins us now. So as we see here, markets continue their rally from what we heard from the Fed comments, that positivity trickling into the end of the week. Now, in your notes, though, you said that the U.S. Fed put that investors have relied on during past crises may be replaced by the China put. Why is that? And what are the implications that come with that distinction?
Sure. Thanks for having me. First off, the Fed put has been something that investors have relied upon for years. The situation today is just wildly different. The Fed finds itself a bit behind the curve. We're looking at 7-8% inflation with a Fed funds rate now at just a quarter of a point. There's very little the Fed can do in terms of providing stimulus if we do find ourselves in a demand destruction type of situation with the economy rolling over. But as we saw this week, China may be in the background willing to provide that extra stimulus, as they mentioned through their promotion of the tech stocks earlier this week.
And so, just while we have you as well, the China put.
It really is the end of the week, isn't it? I mean, it really is Friday here. I mean, I'm waiting for somebody else to walk in the door here.
No worries. They're going to have to break through that step and repeat if they try. But at the end of the day, when we think about this China put, how does that change any of the rotation that investors should be looking at within their portfolio?
Yeah, good question. We don't think it really does. So we are still looking for what we saw at the end of last year to continue through to 2022, which is this kind of internal rotation away from kind of long duration, more interest rate sensitive names, including the ones that are working today, like the big mega techs, and into the more less interest rate sensitive, more value oriented names. So that keeps us focused really on industrials, keeps us focused on financials. You mentioned Berkshire hitting a high earlier today, and then trading off a bit. Keeps us focused on industrials. We still like that kind of value trade. We're still expecting that value rotation to come through into 2022.
So building on that, I mean, we're seeing some analysts saying, look, now's a good time to buy into tech, but it does depend on whether it's stay-at-home tech versus perhaps some of these cloud computing and chip makers. So as you look at some of these value versus growth stocks and the balance right now, how are you positioning your portfolio and what are your top picks?
So we, from a sector perspective, which is what we like to talk in terms of our picks, we are still leaning very heavily into financials, and then after that, it would be along the lines of industrials, and then along the lines of energy. You are absolutely correct in saying the technology. It's a very, very big sector. Obviously, it's the largest sector by far in the United States. It gets dominated by the big names. There's a lot going on underneath of that. But we do remain underweight technology. It is a story of both valuation, but also an economic story going forward. We expect the 10-year and interest rates in general to continue inching higher. We think the comments today from Fed Governor Waller were very, very interesting, really adding to the hawkish feel that the Fed tried to get, or the hawkish thoughts that the Fed tried to get across in the meeting earlier this week. And the market reacted. We think 50 basis points is actually live. It might be live as soon as next meeting or the meeting thereafter. And that, again, keeps us kind of away from those kind of more growth-oriented stocks, which is dominated by technology, and keeps us closer to top picks in financials, industrials, and even energy.
This is all while consumers are feeling the inflationary pressures. With that in mind, where in the economic spending and the retail sales, perhaps, would you be watching closely for any type of demand destruction at this point in time?
We absolutely are. I think that is the big story of 2022 is going to be this push and a pull between a reflationary environment. People are getting out there. They've been locked down for a bit. They're looking to spend some money. And the potential for a stagflationary environment. Are we going to see reflation, or are we going to see stagflation? The old adage still rings true. The easiest and best cure, most effective cure for higher inflation is higher inflation. We don't think we're there yet. Consumer is in pretty good shape. Corporations are in pretty good shape. We think that we'll see this kind of demand stay strong in the second quarter of 2022. As we get into latter parts of the year, now it gets a little bit more questionable in terms of what's the trajectory of of things like gas prices that have really taken a big chunk out of the consumer budget. Are they going to continue? And are we going to be able to kind of make our way around that and see a little relief at the very least at the pump?
So then in terms of the best hedges you can make in this sort of inflationary period, and when you do have obviously some of these other pressures that aren't within the Fed's control, how do you position yourself? If you're a retail investor trying to figure out how you jump in here or waiting for the next dip, or if you've missed it, what are your thoughts there?
Our thoughts, we've been singing this tune for quite a while, which is retail investors and all investors really need to always focus on diversifying their portfolio. And you can diversify and getting out of that mindset that diversification of your portfolio means exclusively stocks versus bonds. They should think about it in terms of kind of the economic scenario. You know, are we in a Goldilocks environment? How would my portfolio react if we were in a stronger growth and a stronger inflationary environment? What if all of a sudden growth begins to roll over, but inflation stays? The easiest way in our mind for the retail investor to add a bit of diversification to their portfolio, particularly with the economic forces that we see at play today, is to add some commodity exposure. It's easy to do that nowadays in ETF space. It's something that we've had in our asset allocation models for years now. It's something that investors have shunned. The performance of commodities have obviously been pretty poor. No surprise, we see a lot more interest in that today, given their outperformance in 2021. But we still think that makes sense from both a tactical perspective and a strategic perspective to get some direct inflation sensitivity into the retail investor's portfolio. It still makes sense to do that today.